Not everything in your trading plan needs to be a rule. Some things should be guidelines. The difference matters. Rules are non-negotiable. Break them, stop trading. Guidelines are flexible. Adjust based on context. Most traders treat everything as guidelines. That's why they're inconsistent. Or they treat everything as rules. That's why they can't adapt. You need both. And you need to know which is which. Trading rules. These protect you from yourself. Maximum daily loss. Stop trading. Maximum position size. Never exceed it. No trading before your routine. Non-negotiable. These aren't suggestions. They're circuit breakers. When emotion takes over, rules stop the damage. You don't think about them. You follow them. Always. How to identify your rules. Ask one question. If I break this, can it cause serious damage? Serious means account damage, psychological damage. Damage that takes weeks to recover from. If yes, that's a rule. Daily loss limit? Yes. One bad day can spiral into a blown account. Position size limit? Yes. One oversized trade can wipe out months of progress. Those are rules. Trading guidelines. These help you make better decisions. Not mandatory. Contextual. Prefer setups at support and resistance. Guideline. Sometimes you take mid-range setups. That's okay. Prefer trending markets over choppy ones. Guideline. Sometimes you trade range-bound conditions. Fine. Guidelines improve edge. But breaking them doesn't destroy your account. That's the difference. Here's the mistake. Treating rules like guidelines. You have a daily loss limit. Lose $400, supposed to stop. But you think one more trade to get back to break even. You're treating a rule like a guideline. That's how small losses become big losses. Rules exist for moments when you want to break them. That's when they matter most. The opposite mistake. Treating guidelines like rules. You prefer high-volume setups. Volume is lower today, but setup is clean. You pass because not enough volume. You just turned a guideline into a rule. Missed a good trade because you were rigid. Guidelines should improve decisions, not paralyze them. Use judgment. That's the point. Build your if-then plans. These are rules disguised as contingencies. If I hit my daily loss limit, then I close my platform and walk away. If I feel frustrated after a loss, then I wait 15 minutes before considering another trade. If I'm thinking about sizing up, then I review my last 3 trades first. These plans remove in-the-moment decision-making. You decided ahead of time. Now you execute. Why if-then works psychologically. You're pre-committing. When the moment comes, you're not deciding. You're following the plan you made when you were calm. Emotion can't hijack the decision. You already made it. That pre-commitment is what separates professionals from amateurs. Professionals decide in advance. Amateurs decide in the moment, practically. Write down 3 rules. Non-negotiable. Break them, you're done for the day. Daily loss limit. Maximum position size. No revenge trading after a loss. 3 rules. Simple. Clear. Now write 3 guidelines. Things that improve your edge but aren't mandatory. Trade with the trend. Wait for confirmation. Take profits at predetermined targets. Guidelines. Use them when they fit. Adapt when they don't. Here's what happens over time. Your rules become automatic. You don't think about them. They're ingrained. Your guidelines become intuition. You know when to follow them strictly and when to adjust. That combination creates disciplined flexibility. You have structure, but you're not rigid. You can adapt, but you won't self-destruct. The compound effect. Rules prevent catastrophic mistakes. Guidelines improve average performance. Together, they create consistent edge. You're protected from the downside by rules. You're optimizing the upside with guidelines. That's the foundation of long-term success. Not perfect trading. Protected trading with room for adaptation. Most traders fail because they have no rules, or all rules. No middle ground. Everything is negotiable or nothing is. Both approaches fail. All guidelines means no protection. You'll eventually blow up. All rules means no adaptation. Markets change, you can't. Build both. Know the difference. Follow your rules without exception. Use your guidelines with judgment. Your trading plan needs structure and flexibility. Rules provide structure. They're the boundaries you don't cross. Guidelines provide flexibility. They're the principles you apply with context. Together, they create a system that protects you from mistakes while allowing you to capitalize on opportunity. That's how you build consistency. Clear rules, smart guidelines, and the wisdom to know which is which.